Thanks for tuning in to this episode of The Resilient Advisor. My name is Jay Coulter, and this is part of the ETF Story series on The Resilient Advisor. And today I'm speaking with Tim Seymour, and we're going to go deep on the Amplify Seymour Cannabis ETF, symbol CNBS.
Every ETF has a story, and some of them deserve to be told. ETF Stories from Resilient Advisor brings you some of the most interesting stories from the world of ETFs. Learn more by visiting etfstories.com.
Tim, I appreciate you coming on ETF Stories. We like to cut through all the fluff and get right to it. The Amplify Seymour Cannabis ETF aims to capitalize on what's transpiring in the cannabis space. Let's start with the investment thesis behind cannabis.
Hey, Jay. Thanks for having me. The investment thesis around cannabis is this is a maybe an overused term, but it's a generational investment opportunity in a sector that many folks know is a social movement, a legislative movement, and it's a high growth demographic consumption movement. And so investing around cannabis is investing along consumer trends, not dissimilar to investing in other consumer sectors. In fact, a lot of folks that are investing in cannabis are soon to be, I think, will be investing in cannabis, will be very traditional, sophisticated CPG, consumer packaged goods, a sector that clearly is very sophisticated when it comes to things that define and separate brands. And ultimately, distribution, marketing, advertising, obviously brands themselves. But what's happening in cannabis is really not only the culmination of years of, I think, political pressure, legislative dynamics that were slowly changing in this country about a decade ago. A lot of focus on social justice, criminal justice dynamics around incarceration, frankly, of minorities in cannabis. And I think it's a really important part of the complexity of this issue. And I'm proud to be part of this industry because I think it's truly giving a voice to folks that actually need a voice. But mostly for investors. We're talking about year-over-year growth rates of 40, 50, 60% with companies that in many cases are now very successful, very profitable companies, even though we're very, very early in the progression of this industry.
When did the ETF launch?
We launched in July of 2019.
Okay, so you have some traction now. Roughly how much do you have under management?
Management's about 160 million, and it's clearly been a case where out of the gates, I think it was a case a lot of folks were not only trying to determine how they were going to access investing in cannabis. A lot of folks still don't have the kind of access to investing in cannabis and cannabis ETFs as I think they'd like. I think we've seen a nice progression where institutions have gotten comfortable. Our fund has gone out of its way to make sure that we're only investing in that which we can invest in as a SEC governed 40 Act product that has to follow a lot of rules. And I'm happy that we have that dynamic. So we haven't taken chances with investing in companies that are really outside of the legality of what we can invest in. So it's been an exciting time to be growing in the space, and the product definitely has evolved. And we've had to go through probably 10 times the amount of red tape and 10 times the amount of I think bureaucracy as you might opening another ETF. But that's not only made us stronger, but it's been happening at a time when the industry's been evolving so fast. And it's one of the things that we think gives us an edge. I mean, our fund has been there from the beginning in the early days, but also we're evolving very quickly with the industry.
All right, I'm going to pull up my Y Charts account and let's talk about the portfolio construction here. So this is an actively managed ETF. Correct. What is the thought process behind the portfolio construction?
Well, first of all, active and active in terms of the construction around the companies that we can invest in. Again, 80% of our portfolio has to be companies that have more than 50% of their revenues coming from cannabis. So we're not investing in tobacco companies that might be in cannabis someday. We're not investing in a Scotts Miracle-Gro that everybody knows that the fertilizer and the ag space around it. Look, and it's no discredit to Scotts. They've been very opportunistic in their business, certainly very complementary to this. But so we're invested in cannabis companies, and where we're in our non-core names, so that 20%. Sometimes it's a lot of cash. Sometimes it's to be defensive. Sometimes it's in testing companies and maybe a couple of the pharma companies that we think are that much more rooted in cannabinoid sciences and whatnot. So in terms of a subsector approach, no specific allocation that says, hey, I want to be in cultivation or kind of manufacturing, or I want to be in only retail and distribution, or I only want to be in kind of medicinal. And I think there's a lot of different subsectors to break up investing in cannabis. I prefer to think about it along similar lines as to what people think about when they're investing in other industries. And I think what you're going to see in the next 2 to 3 years, even more so than the last 2 to 3 years, there's going to be a very clear line to investing in not just manufacturers and processors, but also distributors, and then obviously retailers, and then around that, technology companies that are ERP, logistics, POS software, those companies that are big data plays, those companies that in many cases are the picks and the shovels, whether it's hydroponics players, equipment manufacturers, testing. So I think that's how we think about the sector. We think about the sector. It's an ETF that's supposed to be thematically focused on cannabis. So I'm investing in those parts of the industry that I think are most relevant today, and with an eye, and also invested in the ones that I think are going to be the right place to be tomorrow. So at the risk of stealing the Wayne Gretzky metaphor, we're trying to skate to where the puck's going to be in terms of some of the plays that we have in the portfolio. But what we're focused on today is very different than what we were focused on a year ago. And much in the way that investors in cannabis have found that early days of investing in cannabis, some of the metrics around how people were analyzing companies were ones that anyone that's been in the sector for a while would kind of laugh at today. But funded capacity, it's an asset-based multiple around how large the company's cultivation footprint was, whether it made sense or not. And in many cases, this was most extreme in Canada, some of the first companies to really become investable, where the size of the addressable market in Canada is tiny, tiny relative to the United States. And yet these companies that were building enormous warehouse facilities, some of them really sophisticated, but it made no sense in terms of ultimately where they're going to be selling. Because right now, and I think for the foreseeable future, Canadian cannabis isn't coming to the United States, and U.S. cannabis isn't going to Canada. There is an argument, and there certainly is some discussion, and there certainly is some success in exporting into Europe, exporting to Israel, exporting into other federal dynamics where it's acceptable. So in terms of what we're invested in, though, look, today we own what we think are some of the most profitable companies in cannabis, and some of those companies are vertically integrated companies. They're companies that are seed to sale. They're companies that in the United States are companies that we think are in some of the most profitable states to do business. And in many of those states are not the ones you'd think about as an investor or someone that's somewhat new to cannabis. You'd think, California was one of the first states to go fully legal, like it is in the wine industry, like it is in the food industry, most sophisticated products. Isn't that the place to invest? By the way, kind of right as it relates to cannabis. It is a cultural center and the largest cannabis market in the world if you think of individual states. But it's a very challenging market for the operators. It's been less profitable. The regulatory environment there has been, I think, challenging for even the best operators. So some of the best companies right now are the ones that are set up east of the Mississippi, where they have core businesses in Illinois, in Michigan, in Pennsylvania, in New Jersey, which just went into an adult market. So, but we have technology plays. We own a SPAC, which I owned early in the SPAC, even before it de-SPAC, because I had a sense that the sponsor group around this was a very talented group tied into cannabis, but also folks that had been, financial investors, in fact, emerging market investors from my past life. I've been investing in emerging markets, and as a guy that thinks about the cannabis investment story almost as a developing asset class as well, that story at Silver Spike, which essentially de-SPAC'd the company Weed Maps, which could be the DoorDash of cannabis. That was a story that I was on early because I really just I had a lot of confidence in the sponsor group, and then it's a technology story that I think is really where one of those places where the industry's going, and I see the multiples outside of the sector. So we're invested in pretty traditional in terms of cannabis companies, vertically integrated, I should say. We're finding the best ones, and I think we've avoided the ones that are not so profitable. And it is important to say, Jay, it's not just what we're investing in, but it's what we have not invested in. that I think is a big part of it. A lot of investors have invested in cannabis companies and have seen disruption of capital. Some of the Canadian companies that listed on the U.S. exchanges because they could, and because they're the deepest markets in the world, had the most access to capital. And frankly, some of those companies were just not good operators, very dilutive capital market cycles, wasting capital, destroying capital. And I just say that I spent a lot of time. I knew which companies I didn't want to invest in as much as I knew which companies I did want to invest in, especially in those first couple of years in the fund.
So, Tim, I want to pull up the holdings, but first, before we do that, thinking as a portfolio manager or a financial advisor, adding this thematic ETF to a model, you're really going to bring down the market cap. So you're 40% allocated to micros, just over 30% to small. Is that always going to be the case for this thematic, or is it just because it's a new industry?
No, I think it's a combination of the industry's life cycle and the kind of companies that can come to market, and again, the limitations on some of the ones who we might see in the market. So for example, a company like Curaleaf, which is in the portfolio, and I'm not sure what you're picking up there in that chart, but we have swaps on a handful of companies that we own that are U.S. companies, because that gives us the economic performance of the companies without actually having to own the company directly. So what you can see, I'm looking at what you can see, and looks like, yeah, I'm not seeing that up there, or I'm not seeing Green Thumb, and I'm not seeing Trulieve. And so we own about 6 companies, 6 U.S. plant-touching companies on swap, effectively the same, absolutely the same economic participation of the underlying, but it allows us to own U.S. plant touching at a time when federally that's not legal in the United States, and we run a 40 Act product. So Curaleaf is a $10 billion enterprise value, and they're a 5% position in the fund. GTI is a 6 billion enterprise value, and it's a 5.5% position in the fund. So partially what you're seeing, I think, is a function of just not seeing the swap positions that are a big part of the balance sheet as well. But that, look, even the Silver Spike entity is a case where this is a company that in SPAC form, and when you look at really the size of the company relative to the opportunity set and where we expect this company to be in the next couple of years, I think a lot of these companies are evolving very quickly. So yes, the nature of the industry is also that a lot of the biggest companies in the space have been hydroponics retailers, a grow generation, a company like or a REIT like IIPR, or some of these are names that we have a lot of confidence in owning, kind of the periphery around the sector, and these have been names that were names that we got in on early, and we actually concentrated up and had bigger weightings in. And we've actually taken some of those weightings back a little bit because some of these companies have run a lot. Again, active management, which means I don't have to wait 6 months to rebalance the portfolio if I think a stock has had a very big run. So, but to kind of tie up the question about, hey, for advisors out there looking at market caps of the portfolio, no question, this portfolio is going to be moving into, I'd say, an even middle to large cap market position, probably in the next 2 to 3 years, that much more. And just also know that there's a limit to liquidity on the downside in terms of what I can hold. Also, we have liquidity dynamics that I can invest, for example, in companies that are in the U.S. that are smaller than $75 million. If they're foreign companies, if they're less than $100 million. So we're my guys, my compliance guys, my ops guys, and I keep an eye on the overall liquidity in the portfolio, because I think ultimately the size of an ETF, and I think a lot of investors know this, but let me make this clear. It's the efficiency of investing in that ETF is not really a function of the size of the companies, or the size of the ETF for that matter. We're 160 million-ish ETF, which is decent size for sure, and allows us to give people some confidence that this is a real entity. But it's really a function of the sum of the parts of the constituents of the ETF that gives you that overall liquidity. And I encourage investors to take a look at that and all of the ETFs that they're going to be investing in, not just in the cannabis space.
Excellent. I didn't even think this tool, I'm sure, does not pick up the swaps. So clearly there's going to be some opportunity there for this to have a little bit more size to it. When I look at these holdings here, advisors love a good stock story. Your top holding, Tilray. What's the investment thesis there?
Yeah, and that's a controversial one. So Tilray is a company that, as of 2 months ago, was barely in the portfolio, or certainly as of 6 months ago, was barely in the portfolio, and arguably one of those names that I'm talking about from Canada that I think destroyed a lot of capital. They were the first Canadian company to list on the NASDAQ, and there was a high-profile IPO. It was brought by Cowen, and a lot of people jumped in. This is a company that had they quickly set out and created some JVs with some very large, well-known consumer products companies, including Anheuser-Busch, including Novartis Sandoz, including Manitoba. And some of these JVs were really just, MOUs and not really much of anything, but there was a lot of great headlines around this company. Ultimately, in terms of the size of their revenue profile and their ability to operate profitably, no, not at all. In fact, this is a company that I think a lot of people got destroyed in early, and it's a name that we actually didn't want to own for a long, long time, and had, at least relative to what benchmarks might be, especially market cap benchmarks. At one point, this was a $20 billion company when the market cap was squeezed higher, also around some dynamics, not quite Reddit rebellion stuff that was going on, but as we got into the summer of 2018 and into 2019, it was really just a case where a lot of institutions who wanted to hold it, it was the only exposure institutions could get to cannabis. So that pushed the stock higher. And then there was a lot of institutions that said, this is a bad company, it's way too expensive, and I want to short it. And it did lead to a short squeeze. But that's the company that we really never invested in. The company that we're now invested in did a merger with a company called Aphria about 3 months ago. Aphria, to me, has always been the best operator in Canada. They've been the most profitable company in Canada. In fact, they showed at least adjusted EBITDA profitability well before anybody else in Canada, and well before many in the sector. Aphria is run by Irwin Simon, who's a CEO that some investors may know from his time at Hain Celestial, which was one of the first organic foods brands that really built a very big loyal following, but also a very sophisticated consumer products company. And Irwin was brought in to run this company about a year ago. So he brought an expertise and leadership to a company that I thought was already the best operator in Canada. And at a time when I had a limit to the companies I could really invest in and put a lot of size behind because of the nature of liquidity, I had a pretty good size position in Aphria. When they decided to merge with Tilray, so you basically took two of the three largest Canadian operators and brought them together, I thought this really was an opportunity where this company could actually now go on the offensive. And I think Tilray, which is now the combination of Aphria and Tilray, now led by Irwin Simon, now a profitable company, and also a company that I think is looking globally and is looking at the United States, is a really interesting story. Even if I don't think that they have the same addressable market right now as a Curaleaf or a Green Thumb, and I do think that they're going to be doing some tactical M&A. The tactical side of this position, and I know I've been talking a long time, I just want to finish with this though. The key to Tilray also is that this is a stock that, starting in January or so, even before this merger, was starting to get mentioned in some of these Reddit chat rooms, and was starting to become one of these stocks that was getting a Reddit rebellion bid to it. And I started nibbling at the company as I watched this happening in the cannabis space, like it was happening in other spaces. And again, big short interest in cannabis companies, some companies with actually some catalyst to seeing maybe there be some concerns about short covering and short squeezes. And so I started investing in Tilray even before the merger, as it went into this squeeze into February and squeezed up a few 100%. At one point, and at least from where it started trading the year, and then pulled back. And we were kind of active. It wasn't a big position, but then once they did the merger, and one of the things that I found with Tilray is that even in the last couple of weeks, as we've seen a resurgence of the GameStop AMC kind of behavior, Tilray is a name that finds itself sometimes with that kind of support. It's not why I own the stock. It's not how I would ever be picking stocks in this fund. In fact, if anything, I was using some of that momentum to actually fade a little bit of strength. When a stock's up 30%, to me, that's in my portfolio that I own for fundamental reasons in 4 days, and I think some of this is irrational, I'm actually taking a little bit of profit. So I didn't sell a major part of that position last week, but I was in the market selling a little bit on days when I saw it gapping higher when I don't think it reflected the fundamentals. So it's a long kind of way to talk about one position, which is, I think, a very controversial one, because I don't think that they're necessarily the best company in cannabis right now, even though I think they're very well positioned for the future.
Tim, isn't it amazing that you have to consider the Reddit effect when you're managing a portfolio today? It's unreal.
It's unbelievable. And all I'll say is one of the things that I believe puts CNBS as an ETF in cannabis that's active in a place where we're very different than others. I'll let people decide better. But look, I've been a portfolio manager for 20 years of my career, and a lot of that has been in developing markets. So in emerging markets, especially at times when those markets have been going through periods where you see liquidity surges or where you see fundamentals change, and they're shallow markets, and sometimes they're inefficient markets. And that's kind of how I've grown up as a portfolio manager. I think that's really important to how I look at this portfolio at all times. I think this asset class is re-rating and going to continue to move higher on the liquidity curve with much bigger companies, as we talked about. But I think that's really important to managing a portfolio in cannabis. Being a portfolio manager, not just someone that's collecting assets. Having conversations with companies. I do, I'm not going to put a number on it. It's many, many company meetings a week. I also sit inside of a firm called JW Asset Management, where I'm part of the investment committee. It's the largest hedge fund in the cannabis space. So we're speaking to companies all day long as it relates to both private and the public market. So my perspective on the industry is one as a portfolio manager and also as one that's really in the industry.
Excellent. Tim, it's a great story. Symbol CNBS. For more information, please visit amplifyetfs.com/CNBS. Tim, thanks for coming on and telling the story.
Great to be here, Jay. Great to have this conversation in the forum to do it. So thanks a lot.